In this video, guys, let's have a look at when to hold a trade and when to try to just grab a quick profit. Stay tuned. Hey guys, okay, warm welcome to you. Appreciate you joining me. All right, so the question we have very often as traders is, hey, when do we hold a trade? When do we look for those kind of longer multi-day runs if we're swing trading? If we're day trading and we kind of hold it right until the close, or if we're swing trading on a short time frame, do we hold it? You get the idea. How do we know when we should take a quick profit and we should kind of look to hold it for a longer move? Now listen, there's no golden bullet here. There's no perfect scenario for everything. This is trading, you know it, I know it. Guys, there's gray areas. But here's a bit of a guide that I go by that kind of helps me decide, okay, should I be taking quick profits here? Should I be kind of looking for an ultimate target and then taking it all out? Should I be trying to evaluate it and run this a long way? And actually, really in current conditions, this is something I've evaluated a lot. I've taken a lot of time. You know, at the beginning of the current volatility, I was caught a little bit on the back foot. I was a little bit out of sync. I was looking for the kind of longer term, not longer term, the trades that were running longer. They kept reversing back on me, and I always felt a little bit out of sync. Reevaluated lots of things, this being one of them, and now feel very much in tune with things, having a lot better read on whether I'm just going to take my profits now, which ones I'm going to try and hold and squeeze a little bit more out of. And this is the kind of patterns and the rules, if you like, that I like to follow. So first thing is what's the range? You know, even in the current conditions when we've got the 1500 point Dow ranges, there's still a range. You know, we still have technically kind of this scenario, or wherever we are now when you're watching this, you know, even though that may well be like a 4,000 point range, it's no different to it being a 400 point range over multiple days many months ago. So regardless of the order of magnitude of range, you still have to mark out your levels. So there's your level, right? So they now know that this is kind of the scenario we're in, that people are agreeing on price between this level. Bear that in mind as we go to the next one. The next one is, what's the expected movement? This is key, because if you're a day trader and you're expecting I mean, these numbers are crazy, but this is the current condition. Let's say you're expecting a 3,000 point move, for example, and we've been doing average range of 1,000 points, you're not likely to get it. And forget about circuit breaker issue for now, but you're unlikely to get it. And it's the same as, you know, if we go back and we're looking at a currency pair, we're looking at anything. You know, if you're expecting, you want to take a 200 point move and we're getting average of 100 points, then you're asking more than is normal from the market. Now, that's not always a bad thing, but you've got to justify that. Have we got a catalyst? Have we got something that would warrant me asking a lot more than we have had from the market? And it's the same if you're swing trading. What's your weekly range? Okay, my weekly range is X, and I'm looking for 2X over the week period. You've got to be able to justify that. Otherwise, you know, you can't really expect the market to give you something that very rarely it does. So what's your expected movement over the holding period of the trade? Third thing is, what key levels are in the way? I'll make sure that's a little bit clearer for you guys. What key levels are in the way? So in other words, hey, if you're long, let's see long here, there's a massive resistance and you're long, you've got to bear that in mind. You know, if you're looking for a kind of trailer that's going to go on and on, you know you've got to clear that level as a roadblock, as a stumbling block before it really starts to get going. So, you know, you've got to, whereas if it's just fresh air above and you've got a catalyst, you've got all these things, there's a different scenario. Okay, and then what's the underlying trend? This is the big one, right? This is the one that we tend to forget, especially when we're kind of zooming in on things rather than looking at the bigger picture. You know, if we are buying a pop back up after a big heavy down move, then we've still got to respect the fact that yes, we may get a V-shaped reversal, but we've got to think unlikely. The chances are we retest some lows, we retest some levels, we oscillate a bit and backfill, and so the prevailing pressure is ultimately down. Okay, this could be flipped on its head whenever you're watching this, by the way, guys. The point is, what's the prevailing pressure on the asset you're trading? And if that happens to be down, then, you know, looking for that real extension, running profit to the upside. Of course, it's going to reverse at some point, but potentially, not always, of course, but potentially it's going to reverse at some point. But, you know, will it have to be now? Is it not better just to kind of bank a few rallies if you're trading that counter trend, and then look for the bigger move when the conditions are a little bit more aligned? Who knows? But anyway, so let's look at these in total. So first of all, we're looking at the expected range of our trade. And now, if their expected range is, hey, it's this, and let's say we're trading counter trend, then we might want to consider just taking a quick profit. So for example, if we bought kind of down here and it's kind of spiked back up and our expected range is kind of here over the multi-day period and the price then moved up to here, we might say, you know what, let's take the trade out and let's look for the next move, because we still have downward pressure. It's not like we're kind of running up and we're really strong over the long term. So that might indicate that we take some off the table. And we might also say, okay, there's a big key level there as well, right at the end of the stretched expectation of move. So let's grab the quick profit. However, if we are, let's say we're selling as we pop up into a spike here. Let's say we shorted that. Okay, we have the wind behind us, we've got a long-term downtrend. Yes, we've got a kind of a expected move of probably this, fine. However, we've also got a barrier here of support. We might go fine. This might I might want to give it more chance, and I might say, okay, well, I'm not going to take a quick profit because I have a lot of weight of the trend behind it, expecting this thing could run. Maybe I look for a break and then trail my stop after it breaks and have a little bit of a different expectation to it. Or again, guys, there's no right or wrong with this. You might look at that and go, okay, well, as far as I'm concerned, we're still in a range. So I'm going to take out all my trade when it comes to the bottom of the range, regardless of how key the trend is or not. That's a decision for you to make. You may well say, actually, I'm only going to look for my runners when we actually break out of the range, and that would be absolutely fine, and I would agree with that as well. Okay, while we're in that range, I'm looking to bank profits, bank profits, bank profits, bank profits, play the range, forget about the bigger picture, just focus on what I want to trade, bank those profits, work around that. When we break out of it, if you can take a trade in a direction, you might be saying, hey, I'm not going to look for a quick profit. If we get a breakout and I'm on the end of a breakout, I don't want a quick profit. I want this market to pay me for the risk that I'm taking on this deal. And so as it starts to break through, you go, okay, now there's no target here. I'm going to reassess it every day. I'm going to reassess it at whatever time if you're day trading, and I'm going to see, and this is the things that I want to see before I decide to close it or to scale it. And that is the key thing as well. You've got to know what I need to see. What reversal pattern do I need to see? Because you're not expecting just to fall through the floor and give you a jackpot trade straight away. You're going to get retracements. You're going to get tests. You're going to get little probes. Even if you want to hold it for multiple days for a final capitulation in this example, you still have to have something that says, hey, what would get me out of the trade? What am I actually looking for? I'm looking for 4 days of up move. Am I looking for a retest back up? Am I looking? Your decision making process needs to go into overdrive here and say, okay, this is exactly what I want to see. Because even though we're trying to distinguish here between taking a quick profit and running them, ultimately you still need to have a reason in your mind as when you're going to close the trade that you're running. Otherwise, you'll just close it as soon as you get a big profit. You'll close it, you'll run. So I'm going to run this, I'm going to run this, and it'll be working really well, and you'll see a P&L and you go, I don't want to lose that, and you'll bank it. And in reality, the trade was just getting warmed up, and you could have made 4 or 5 times that amount if you'd have kind of stuck with it, stuck with your initial decision, and had a valid reason for closing the deal, as opposed to just coming out just because it's a good profit, you want to take it. All right, guys, hopefully that's given you some framework. I like to work from this. I like to think, okay, where are we? What's the range? What's the underlying trend? What can I genuinely expect from this market in the time period I'm looking to hold it, and then working around that. And if I'm, there's nothing wrong with banking profits. There's nothing wrong with taking, especially in the current environment where those moves are big, nothing wrong with taking a trade, flattening up, reevaluating, and coming back in. You don't have to be in a position all the time. You don't have to hit the home run, and they're just as good as each other, because the home run could easily take, that could sit in that range for a long period of time before it finally breaks. And if you're always looking for the break, you're constantly going to get stopped out, and then you finally get it. Whereas the person who was looking and taking the kind of chunks out of the market along the way, even if they didn't catch the home run, it's probably done better. So you get the idea. It swings and roundabouts, pros and cons. But I think if you align yourself with that, and you have a pre-structured plan before you go into the trade, it makes life a lot easier. Anyway, guys, I hope you enjoyed this video. I hope it's helped you in some way. If you have found some value from it, then I do appreciate a thumbs up and appreciate your comments and all this kind of stuff. Take care. Bye-bye.